Have to excuse me, I'm a little bit excited tonight. We're doing something different. In case you can't tell, this is being streamed live on the internet as we're speaking. We've never done this before, maiden voyage. We're not going to be able to do the CLE. The bank has some regulatory compliance issues, but we're testing this system out and I'm excited. One of the things that we're about is communicating, getting information to people on a timely basis so that you guys can be the best you can be out there. Years ago, we used to put letters through a memory typewriter and mail them out, and then we used to start faxing them, and lately we've been emailing a lot of stuff. How many emails do you get a day? Like in my box, like 100 or something? It's getting lost in the email. So we're experimenting with some new stuff on how to get information out to the professionals, you guys, so that when you're up against something, you're going to be as prepared as you possibly can. So it's an experiment, but welcome to our experiment. I have one thing that I want to touch base on before I give the microphone over. Have you guys talked to Chris Quinterno in my office, senior counsel, clearing your exceptions and stuff? He frees up a lot of my time. He's very good at what he does. And that allows me to take a little bit more time and see where the industry's going. You've heard of blockchain. You've heard of the technology where some counties are playing around with they put blockchain in front of the Cook County clerk and he looked at it and he kind of laughed and walked away. If you're going to lose sleep, you're not going to lose sleep about blockchain taking over what's going on with your real estate transactions. You hear a lot about digital e-transactions, where everything's going to happen remotely and over the internet, and you see parts of that coming together. You see digital documents, you see digital signatures going on documents. You know, it wasn't all that long ago the first time they asked me to sign something digitally. I was in a retail shop and I said, no, give me a piece of paper, I'm not going to give you, but that's become a very common thing. Right now they're talking about remote notaries on the documents too. But between you and me, I don't think that's going to be something that, looking around, we got a bunch of gray in the room, not ladies accepted. I don't think it's something that you're going to have to worry about while we're still practicing. But if there's one thing that I wanted to point out that's going on these days that if you want to really pay attention to, that's cybersecurity. This is no joke. I've always taken this stuff personally. You're familiar that they have cyber regulations for title insurance agents now. There was very little we had to do to adjust for that. We had a lot of things in place. But I think the biggest place where we need to pay attention as an industry is educating the consumer. The consumer, you know what, these bad guys out in cyberspace, they have everybody's email, they have everybody's passwords. They're not going out and opening up dummy accounts, but they have computer programs that are tracking everything that goes on, and they have keywords set up. If they start seeing real estate, they start seeing funding, and they start seeing closings, they see enough of that, and all of a sudden that gets their attention. And they will, and they do, just send in a little email, giving it a spoofed email. It looks like it's coming from someplace, but it's really not coming from them. I get them I don't think I called anybody here, but every once in a while I get something that looks like it's coming from a client, and it looks good, but it's spoofed. Somebody else just made it up. There are people out there that will know who the players are because they're reading the emails, and they'll send them an email that says, you know what, everything's go, wire me the money. And when you're dealing with a real estate transaction and they wire the money out, it used to be millions of dollars was lost on that on a regular basis, on an annual basis. It's in the billions at this point. People, they look at it, they don't think, they're busy doing. If there's anything that we can do to help, especially the consumer, I think the people in this room, professionals out there are a little bit more aware, but it's just such a, if there's a problem, if there's something to lose sleep about, it's people sending money and they never wind up getting it back. What does that have to do with reverse mortgages? Absolutely nothing, but those are the things that were on my mind. What I'm going to do is I'm going to pass this over, a few housekeeping rules. Cell phones on silent, can we do that? That way when the speaker starts, we won't be interrupting the speaker or the people next to us. Did everybody sign in? We need you to sign in order to make sure that you get credits for your attendance here. We will be taking a break about halfway through. It's almost 7 o'clock now, so somewhere around 8 o'clock we will be taking a break. So if you need to refresh or you need to make a phone call or whatever you need to do, you'll know that we'll be taking a break and won't be missing anything. Housekeeping, we will have sign-out sheets for you. We'll have evaluation sheets for you. We'll put them out at the halftime. Other than that, I think that's all that we need. I'm going to give this over to Chris. Chris, could you come up for a minute? Chris has one thing. There's constantly new stuff going on in the industry, and Chris is going to address one of those issues for you.
Thanks, Tom. Good evening, everybody, and welcome to our first of our spring seminars. Yeah, I have to get to the podium because I have some notes over here. As we all know, can you hear me out there? Sorry. As you all know, the state passed their budget on April 1st or 2nd, and of course, under the heading "Killing the Golden Goose," they've increased the tax rates for both New York State transfer tax and the mansion tax. So in your materials tonight, I added a sheet. I added a chart which shows the increase for both. If you turn to that, the new rates apply to transactions for New York City properties only, and it takes effect July 1st of this year. Contracts entered into on or before April 1st aren't subject to this new rate, but you have to submit the contract with it in order to pay the lower transfer tax. Since I've been in this business 35 years, the rates have always been $4 per thousand on all transactions, but the new rates will be $6.50 per thousand for residential properties of $3 million or more. So it's going to continue at $4 a thousand for residential up to 2.99 million. Any other property, the consideration of $2 million or more, it will also be at 6.5. The good news is the transfer tax is still paid by the seller.
Excuse me, is this New York City only?
Only New York City, yes.
Because I've been getting, emails that say, or cities of 100,000 or more.
No, 1 million or more.
2 million.
1 million or more, okay.
Yeah, no, 1 million or more population-wise, and that's, since I've been reading the statutes over the years, that's just, I guess not to make Syracuse and Rochester feel bad, that we're the only city over 1 million people. Mansion tax was also increased, which is only fitting because it came into effect in 1989 by Governor Mario Cuomo, and now Andrew Cuomo is putting his imprint on it as well. Also, it'll be for New York City residential properties, used in whole or in part as a personal residence, including 1 to 3 family, condos, and co-ops. The tax is still paid by the purchaser. However, there's language that corresponds with the law for the transfer tax that both the grantor and the grantee will now be held jointly liable for the tax. If the grantee fails to pay it or is exempt from payment of the mansion tax, then the obligation passes over to the grantor. The rates are calculated 1% for transfers of residential property of 1% or more, which is no increase. But where the increase takes effect, there are supplemental rates depending on the consideration. From 2 million to almost 3 million, it's 1.25%. And if you check on your chart, it increases until you get to 25 properties of 25 million or more, which I hope all of you have in the coming year. The mansion tax is a whopping 3.9%. So this is a nice money grab for the city of New York, and I'm sure they'll spend every cent. But it's up to us to.
Is that for $1? If you put $25 million into 6.25 on the whole thing, or
Yes.
graduates?
No, it's not graduated.
So you're gonna roll it back, so if I'm, now you gotta start doing all these guys where it's 1,999,000? Is that really what?
Well, you know, we've had that over the years where the price on it's $998,000, so they don't pay the mortgage tax and they're paying, you know, a few thousand under the table. So, you know what, real estate attorney, not a problem. Anyway, yes.
With
yes, ma'am.
new construction where you put the transfer tax in and then you pay transfer tax on the transfer, are they still gonna do that with
Oh, yes, yes. It makes for a lovely exercise in our office when we have to prepare a bill for the 4th time, and we're rolling the tax in and telling you, and now this is your tax on top of the tax.
Right.
So, and David, we've seen that before. So, that's my update to you for the upcoming increase in the transfer and the mortgage tax. Tom?
Let me take it down. Now, our presentation tonight is due in a big part to our lender Nationwide. They're providing the speaker, they're providing the expertise, these guys know what they're doing. Before we actually get into the program itself, Rohan, do you want to talk to them for just a minute? Introduce yourself.
Good evening, everyone. On behalf of MacGregor Abstract and Nationwide, I welcome you all here this evening. We're going to try and fill you up with a lot of good information. I just want to talk about a couple of things about Nationwide and what we do. We're not just reverse company, well, although we are gurus in that area, and we do have a guru here to talk to you tonight. I do want to introduce a couple other people who work extensively in the reverse division. Eileen Rosen, Ron Green. Hi, everybody. I want to talk to you a little bit about what I do. Like I said, my name is Rohan Barnes. I'm the Vice President for Community Lending Division with Nationwide. What we do primarily is we work with first-time home buyers to assist them with grants. The latest grant that we did was a couple, 4 children, buying a house in the Bronx. We just got their clear to close, I think, today. We gave them $25,000 free money from the state. We were able to get him into the home with as little as $5,000 out of his pocket. We gave him another $11,000 towards his down payment, and we structured the loan with a seller concession, and then on top of that, we gave him another $12,000 to do repairs on the house. And we do these grants all day, every day. Last year, we were able to help a little over 45 different families qualify for those grants and obtain home ownership. Last year, we qualified one gentleman and his family, bought a 2-family house in East New York, Brooklyn, and we were able to stack 3 grants on top of one another and gave them $80,000. And these grants are available. I know a lot of people think it's fake news, but it's real. We do it, and I've been doing it now about 8-9 years. But I just wanted to touch base on that. Yocasta Rodriguez works with me in that department, and she can tell you a little bit more afterwards. Without further ado, I'd like to bring up the guru, Mr. Rob Tolan.
Too kind. Thank you, Rohan. Wow, very kind words. Good evening, everybody. My name again is Robert Tolan. Thank you to my team, Ron Green, Eileen Rosen, Rohan, Jocasta. We really do work as a team. And thank you, Tom, for putting this together. This is awesome. And I hope that what may seem like a boring topic, reverse mortgages, I can make it a little entertaining for you, and more importantly, come away with some knowledge that you didn't really have coming into today. And with that, I'm going to need some information from you. So I don't know what you know, what your misconceptions may be, or what your knowledge base is on reverse mortgages, but I do want to be able to answer everybody's questions, and I am going to make some assumptions. Is it safe to assume that everybody knows when they do a reverse mortgage, whether that be to refinance their existing home that they're living in, or to purchase a new home that they're going to be living in? Yes, you can get reverse financing to purchase a new home. Many of you, show of hands, does that everybody know that you can use reverse financing to purchase a new primary residence? This is why we're here. So, to me, this is rudimentary, this is common knowledge, but for many people, and you guys are all the trusted attorney, right? You're a trusted resource for our seniors out in our community, and nobody knows about reverse for purchase financing. So we'll talk a little bit about that. How about a show of hands? Who thinks you give up title to your home when you do a reverse mortgage? That the bank now owns the house, and eventually your children or whoever inherits your home is just going to hand the keys to the bank. All right, that's good. Right? This is a loan. It's just like any other loan. However, it does give you the option whether you're going to make a payment towards the money that bank's lending you, right? Whether you're going to make a principal and interest payment, whether you choose to make an interest-only payment or no payment. You do have that option on a reverse mortgage. Unfortunately, most loan offices don't educate and give the family as well as the seniors that, hey, you don't have to not make a payment. If you want to preserve equity, you can make a payment on this loan. All right? So it is a non-recourse loan. I'm just trying to get some of the basics, I feel like, out of the way. Non-recourse meaning only the house insures the loan. So in the event, as we know, people are living longer today. If you do this loan at the qualifying age of 62 and you live to 122, there's a chance that you're going to not have equity in your home if you're not making payments, right? But it's non-recourse, meaning they cannot come after your other assets. They can't come after your $1 million portfolio or your children's assets, right? They can only come after the equity in the home. If the equity is not there, your children does have the right to say, listen, mom and dad did a reverse mortgage. There's no equity left. They've been here. It was great. They were here 30, 40 years, never made a payment. However, there's no equity. You know, and we have no interest in selling the house. Here are the keys. They can do that. However, the way they're designed today is that there is equity, right? You're not borrowing. When I first got started reverse mortgages in 2007, you were able to borrow at age 70 pretty close to about 68% of your equity, right? Today it's under 50%. Right? We went through a 10% reduction many years ago, and we recently went through another 10% reduction back in, will be 2 years in October. Right? So for this conversation, for this CE topic, and for most of your clients that you're going to investigate whether this loan maybe makes sense or not, whether it be a purchase or a refi, start thinking about 50% is really what it is. It's a 50% leveraging tool, borrowing tool, not against the value of the home, but the value of the home with some limits. And this is new. As of January 1, the new FHA lending limit is $726,525. So that doesn't mean you qualify for $726,525 if your home is valued at that. But based on your age and the youngest borrower, if you're married, it's going to be based on the youngest borrower, it's a percentage of the $726,525. And you'll hear me speak a little bit later on that there is some private money coming to the space, proprietary money. Let's see if we got, who knows Blackstone? I'm sorry, everyone knows Blackstone. Everyone eats there, right? BlackRock, I'm sorry, BlackRock. I get BlackRock and Blackstone mixed up. BlackRock, if I'm not mistaken, is one of the largest private equity firms in the world. Anyone disagree? They see a big need for this type of product without the government involvement. And what they're doing is they private labeled, right? They bought one of the largest reverse mortgage companies that were around since the Robert Wagner days, when he was standing in the Hamptons in front of that big house. They now own that company called Finance of America. They've private labeled a home equity program, not the government program that we're going to be speaking about, because it's not available in New York yet, but it is available in Florida, our sister state. It's available in New Jersey. It's available in Pennsylvania. It's available in Connecticut, but it's not here yet. But it's for jumbos. We can start lending up to $4 million on a reverse type product. Now, it's like a 30 to 35% LTV. So this is for your $500,000 condos here in Long Island that no one could borrow against, right? Everyone's selling their houses and just buying $500,000, $600,000, $700,000 condos for cash. Wait a minute. You may qualify for a HELOC type product that will give you the flexibility whether you want to make a payment, make an interest-only payment, or no payment against a $500,000 plus condo with no FHA, no government insurance involved. Still have the non-recourse feature, meaning if you live to 150 and you owe more money than what your property's worth, they can't come after any other assets. So this is around the corner. And I think it's going to really open up the doors, and as trusted advisors, you need to know about this information. You need to know about the person who's about to sell the house in Woodbury that's going to free up $1 million, but the missus wants to buy for $1.2 million in Florida. Where's that other $200,000 coming from if you want to preserve some equity? You know, why not take a 20%, 30% HELOC and give you the flexibility of making a payment or not? Right? And we'll educate, what does that look like? What's the negative? Right? So this is a little bit what's going on with the reverse mortgage program. The government has really cracked down on what you can borrow. It's like a 50%. Age 62, it's like 40%. Right? It's not a high LTV program, so you need a lot of equity. They've also introduced, and you'll see, financial assessment. I worked at Wells Fargo from 2007 through 2011. Thought I would retire at Wells Fargo and just stay in the Wells Fargo reverse mortgage, drink the Kool-Aid course. Didn't happen that way. We had a financial crisis, if everyone remembers, right? So during the financial crisis of 2008, everyone kind of went upside down. Everyone was like, and we were kind of I think in New York, where I think we were a little sheltered. What was going on in the rest of the part of the country? Neighborhoods weren't even be completed or developed during that time, 2006, 2007, 2008. So the program went through a big hit. The government program said it's national, right? It's a national program. So the house that was worth $300,000 didn't recover as quick when the market started bouncing back, and a lot of people did go upside down during that time. All right. So the agreement was for people to continually pay their taxes and insurances. But if you owned the home in Florida and you pulled out 70% of the equity, you pulled out $210 in 2006, it was worth $300, and you blinked an eye and the house was now worth $150, and your buddy's saying, don't pay your taxes or insurance, the bank will pay them for you. And this is what happened. So when I got involved in reverse mortgages in 2007, also as an ex-occupational therapist back in the day, I knew that the baby boomers this is a great product to get into, right? Every day, 10,000 people are turning 65. However, half the amount of volume is being done on the reverse mortgage program, the government program that is supposed to let people age in place that we're going to learn about, right? Half the amount of volume is being done today than in 2007. Half. Because people aren't qualifying today. We've all trained them that the reverse mortgage is the last resort loan. Last resort loan. Well, guess what? The last resort borrower doesn't qualify for this loan any longer. All right? Because we put some things in place. We want to make sure people can pay their taxes and insurances. What had happened was people went upside down. We had a default ratio that was 1%. Who would ever think that a senior would not pay their property taxes and insurances, right? People that are adverse to debt. Not going to pay your property taxes and insurances, are the first ones paying the property taxes and insurances. It was a 1% default rate when I got involved in the program. After the financial crisis, and everybody listening to their neighbors, how if you're underwater, don't worry about paying your taxes and insurances anymore. What for? You have no equity. The bank will pay them for you, and they made all the money on doing the loan, and the government's going to reimburse them in the end. Well, guess what? It's kind of true. It's what happened. Wells Fargo was begging the government, pre-financial crisis, change the rules on this program. Don't just let somebody qualify based upon a percentage, and if that can clean up that whole mess, then they qualify. No, we want a person that's paying their taxes and insurances now. Not somebody that's not paying their taxes and insurances, not meeting their obligations, or pay judgments and liens, or showing a history of not even the capacity, but what about the willingness to pay your bills? Didn't matter. The program is the program, and the government told Wells, you don't like it, get out of the product. And eventually that's what they did, because they were forced to now foreclose on seniors who aren't paying their taxes and insurance. And if everybody remembers, post-2008, everybody was hating on the big bad banks, right? Everyone hated the banks. Everyone lost a ton of equity in their home, right? So, and Wells, what they were doing is if you don't pay your taxes and insurances, right, we all know that they supersede any type of lien. So the bank's got to protect those liens, and they did. They paid the taxes and insurances until they were getting forced to foreclosing on seniors, and they had enough. They said, we told you years ago we wanted a program with better controls in place. Now we're out. And they were really the only game in town. Bank of America came on the scene late in 2006. Wells Fargo was involved in the program since 1989, when Ronald Reagan said, our middle class, all their net worth is in their home. How do we allow them to stay in their home and enjoy their net worth and paying down that mortgage to zero? Let's let them supplement their income and peel $1,000 or $2,000 to stay in the home. That's what it was intended for. But like everything, you give somebody money and it leads to abuse, and loan officers will also abuse the program if it means a bigger ticket, and that's what went on. All of a sudden, peeling $1,000 a month as a line of credit to supplement your bills became $250,000 as a lump sum to somebody. What is this? Back then, whether you did a fixed rate reverse mortgage or you did a line of credit reverse mortgage, which the line of credit was intended for, right? It was intended to borrow as you need, not to pull out $250,000 or $500,000, whatever it was, in one shot, and then do what with it? It was intended to supplement your income, just so you can, live a better life and stay in your home, pay the medical bills. You're living on a limited income, right? You're not working anymore. But the product got abused. It was very easy for someone to come in, this is a convoluted product to educate somebody on, and say there are two programs. You have a fixed rate and you have an adjustable rate. What program do you want? And what do you think 10 out of 10 seniors say? They want the fixed rate. You're talking about someone that's adverse to debt to begin with, and now you got a variable product. All right? So the fixed rate, all the money comes out in one shot, there's no line of credit, whatever the case may be. Now you gave somebody all this money that may or may not have a good history of paying their bills on time, their taxes, their insurances. You have sons, daughters, grandchildren, cousins, aunts, uncles coming out of the woodwork knowing that someone just did a reverse mortgage. And then all of a sudden, 5 years later, there's no money left to pay the taxes and insurances. Big bad bank. And this is what was going on. So through the years, a lot of controls have been put in place. Some of it good, some of it not so good. But here we are. So that's my little intro into the slides. I'm going to move through pretty quickly. Stop, interrupt me, ask questions. I want it to be a conversation versus me just like what I've been doing for the last 5 minutes. All right? All right, let's move on.